Hello, everyone. Happy Friday. We'll talk about this market's resilient climb to the upside, pushing back above 4,700. We've talked about that range-bound S&P between 4,550, 4,700, eventually getting up to 4,750. We're back up in that range now yet again as we push higher. Today, we're going to look at the S&P in that range. We'll also answer some of your questions recently about volatility, about Morningstar style boxes, many other things from a technical perspective. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using charts and technical analysis to better quantify investor behavior and market sentiment, focus on the message of price, trend, momentum. All of that information the market can give back to us in the form of price movements and things derived from price. You know, overall, we've talked a lot about this seasonal pattern in November and December tends to be fairly strong. The more choppy rotational period that the market has been in, sort of conflicting with that seasonal trend. But a day like today, really finishing in a position of strength. Last couple of days, a little weaker, particularly yesterday, finishing down toward the lows of the day. Today, reversing back to the upside with the S&P, not making a new all-time high, but certainly getting up there on a closing basis with a couple of key sectors really pushing to the upside. And we're going to talk a little bit about technology and some other sectors as well that have shown some consistent strength. Out of the FANG stocks, you have Apple and Microsoft doing just fine, while others not nearly as much. We'll get to all of that and more as we wrap the week from a technical perspective. Great guests this week. We had a lot of fun with Samantha LeDuc and many others this week. Some really good conversations about the market environment and what to expect going into the new year. Next week, three great ones lined up for you. On Tuesday, the 14th, Jonathan Krinsky from Baycrest Partners. On Wednesday, the 15th, Ms. Schneider from Market Gauge. And on Thursday, the 16th, Sam Stovall from CFRA Research in New York. Also, our next episode of The Pitch is coming up next week on Thursday, the 16th, running at 6 p.m. Eastern. I'll be moderating a conversation with Aaron Swenlin from Decision Point, T.G. Watkins from Simpler Trading, Larry Tentarelli from Blue Chip Daily. The Pitch, if you've not seen it before, is a lot of fun. It is a stock picking showdown. Three experts each bring 5 picks with them. We discuss them as a group after they present them. I'd encourage you to check that out coming up next Thursday. Also, the next webcast from Market Misbehavior, I'll be hosting next Tuesday, December 14th, 1 o'clock Eastern, entitled Designing a Market Trend Model. In this free event, we're going to talk about the market trend model I share often on the show. We'll get to it a little later in today's episode, but we'll go a little more in depth in terms of why having a market trend model makes sense, how it should fit into your process, and what this can tell us about the current market environment relative to previous cycles. Go to marketmisbehavior.com/market trend to sign up for that event. Finally, we are running the StockCharts holiday special between now and year end, all through the month of December. You can get a fantastic deal when you upgrade or renew your StockCharts membership, or if you sign up for a new one. If you've never been a StockCharts member before and have just been using the free version of the site, there's so much more. A lot of the really cool capabilities we talk about, like the scanning engine, ChartLists, being able to really customize your charts and make them look certain ways and really capture your perspective on the market. You really need to be a member to take advantage of all of that. Go to stockcharts.com/special to renew or to sign up for a new StockCharts membership. Let us wrap the week. Go to Friday has really 2 pieces. We wrap the week. We focus on how the markets have evolved. We answer your questions in the mailbag. We'll wrap the week first, starting with a poll. We have a poll running on our live stream page at all times on stockcharts.com and also through social media. And we asked you about candle patterns recently. In a downtrend, a long down candle is followed by a long up candle that closes about 75% of the way back up through the first candle's real body. And that is a key piece of information. What pattern is this? 59% of you, absolute thumbs up. You got it right. It's called a bullish piercing line. And you think of it, that 50% of the way up the previous candle is kind of like the level. As long as you get above that, that's called a bullish piercing line candle. If you would go even higher on that second day and eclipse the first day's open, that would make it a bullish engulfing pattern. Flip that pattern over and have it be at the end of a big uptrend, and you have a big up day followed by a big down day where the second day engulfs the first day. That's called a bearish engulfing pattern. And a doji, very different. That's when the open and close are right about at the same levels. All of these terms come from Japanese candlestick analysis. This is a traditional form of technical analysis coming from Japan. Steve Nissen, a number of others popularized this in the West a number of decades ago, in the 1970s, 1980s, if I remember right. But while the names can be kind of funny and at times esoteric, like Abandoned Baby and Three Black Crows and all of these, the way that they visualize short-term market dynamics is unmatchable. I think it's an incredible way of understanding the short-term supply and demand. We saw that recently with NVIDIA and others, where you have a candle and then the market moves very quickly. So go to our chart school pages on candlestick analysis if you didn't know how to answer that question, but congrats to those of you that did. Let's keep wrapping the week here. And what we're going to do is look at our wrap the week charts. What we do every Friday is look at how the markets changed from last Friday to this Friday. And we're going to start with this chart, which looks at starting the clock on December 3rd, which is a week ago, going to where we're at today. How did the major asset classes evolve? And if you follow my mouse and my voice, I'll point out to you which each of these, what each of these lines represent. In black here, this one toward the top, third from the top, is the S&P 500 over this week. Pretty decent week for stocks, and finishing strong today, finishing up toward the highs, made it a 3.8% gain for the week. Not too bad. A couple things outperformed, and in pink you have the NASDAQ 100, which is a rounding error away from the S&P, really finished right about the same. So the S&P and the NASDAQ both up just under 4% for the week. In brown, we have crude oil prices, which are actually up 8.4%. And crude oil had been coming down quite a bit in recent weeks, while stocks had remained fairly strong. You had commodities kind of chopping around, but really pushing back to the upside with crude oil up decently through the course of the week. Everything else sort of underperformed the S&P so far of the last 5 trading sessions. In purple, we have small cap stocks. Very close to that in orange, we have emerging markets. Those were both up about 2.4% this week. Flat for the week, we have gold prices and the US dollar here, the gold colored line and the green line. That's tracking the GLD, and the UUP is a good proxy for the dollar index. Overall, the strength in the US dollar over time is absolutely a key theme to be paying attention to, but a bit of a stable sideways week this week. The big loser for this week, bond prices, with the TLT down 3.6%. We've talked about interest rates and how they've evolved, coming off a little bit here in the last couple of days, but it really come back into that 150 to 175 range for the 10-year yields. We can add Bitcoin in the mix here. That's here at the bottom in blue. So before we were just looking at these asset classes, Bitcoin here at the bottom. Now, Bitcoin's a fascinating chart, going from the upper 60s all the way down through the 60s into the 50s and now into the 40s. And that movement of Bitcoin has been really interesting to see. A lot of weakness overall in cryptocurrencies, not just Bitcoin, but Ether, Litecoin, some of the other major coins that we've tracked. You know, with cryptocurrencies, I've often reminded people there is great potential reward. There's also greater potential risk, and that actually goes back to the basic concepts of investing. The idea of an equity risk premium, that, you know, if you want a no risk and fairly low yielding investment, buy a treasury bond. If you want anything more exciting than that with greater potential reward, you're taking on greater risk. And with cryptocurrencies, it exaggerates that. You're taking on a great amount of risk for potentially a great amount of reward. And we've been feeling the risk side of that. So with anything, but especially with cryptocurrencies, be thinking about that risk side of it. Make sure you're managing not just the upside potential, but the downside potential when you're looking at your markets of interest. To finish this Wrap the Week segment, we're going to look at the Mindful Investor Live chart list. This is a list of charts that I keep updated on StockCharts.com. If you've never accessed this before, you can go to my page. If you click on the Articles tab at the top of StockCharts.com, go to the Mindful Investor, which is my homepage. You can get to this list of charts, and I keep them updated pretty regularly. We'll start at the top and see how far we can get to finish this segment before the break. We'll start with the market trend model. As a reminder, I'll be doing a webcast on this next Tuesday. Go to marketmisbehavior.com/market trend if you want to sign up for that free event. It's going to focus on this model and some other ways of systematically understanding market trend on different time frames. And as a reminder, there's a long-term, medium-term, short-term time frame. And I use those labels fairly loosely. In general, the short term is a couple days to a couple weeks. The medium term is a couple months to a couple years, and the long term is beyond that, is the general way of thinking of it. And that's about what the signals have played out. The medium-term model tends to trigger maybe 3 to 6 months at a time on average, but it can very much depend on the trend. That medium-term model is what I use as my main risk-on, risk-off model. So turned bullish back here in May of 2020. It has remained positive through the course of the rest of 2020 and most of 2021. As long as that remains above the zero line, that tells you that overall the trend is remaining fairly strong. And if we do get a pullback, which we did obviously recently, keeping an eye on something like that to see whether it triggers can be a good way of just thinking, should I be looking more buy on the dip sort of mentality, or more of a get defensive and get into defensive things or cash or whatever, and just sort of ride things out. And it's suggested to not be too cautious, that overall the long-term trend still remains fairly positive. The short-term model, by the way, has now turned back positive, given the strength in stocks. So my market trend model is positive across the board, which is pretty much how this market feels as we're near all-time highs. Let's spend a few moments on the chart of the S&P 500. We refer to this usually at the beginning of every show, just to update on where we're at. And my challenge, as with anyone doing a daily show, is to make sure we disconnect from the short-term movements, what I call the flickering ticks of the market, and have a proper perspective on the long-term trends. Because I would argue for most investors, that's where the opportunity lies, and that long-term sort of cyclical, even secular movements in the market. So where are we at? While we have gotten down to 4,500 about a week and a half ago, while we reached up to 4,750 about a month ago, I see the range is between 4,550 and 4,700. 4,550 was the peak in September. That's when we had a 6% drop to the lows in early October. When we broke back above 4,550, I think that was the all clear signal that the path of least resistance was higher. And overall, that's still how this market sort of feels. We pulled back then to 4,550, and even though we undercut it and undercut the 50-day moving average as well, we've obviously resolved back to the upside. So on the lower end, you have 4,550. On the higher end, you have 4,700. We first reached that in early November. We then retested that a number of times, really unable to get much above there. We had one day where we spiked up to 4,750, but closed back at the lows of that day. We're now right back there and threatening a new all-time closing high today at 4,712. So overall, we're clearly at the upper end of that range. I think that's still the range to pay attention to. When I think of the seasonal strength in November and December, when I think about the fact that December is most likely a strong month, but we've had this choppiness, getting above 4,700 and staying there would validate that overall things are just fine with strength going into year end, or most likely strength going into the year end. 4,550 would be the downside level of risk, and making sure we hold above that would alleviate any sort of really negative outlook. And I think getting below 4,550 would cause me to have a much different perspective on things. Now, having said that overall trend strength, the fact that we're at or near all-time highs, we also have this bearish divergence. And normally I would say just a 5% pullback after a divergence like that doesn't feel like nearly enough. The problem is that's happened a number of times in 2021, and that's been more than enough so far year to date. But again, when I'm learning about divergences, I'm thinking that feels like it's a much more significant reversal signal than the market has told us so far. But having said that, after we pulled back and bounced off the 50-day, the RSI bounced right on 40, which is more of a bull market condition. That's what a bull market sort of looks like. You see that going back here a number of times. Bearish divergence, RSI bouncing just above 40, and that's kind of the buyable dip, and we've seen that yet again. So we've seen this repetitive pattern. Certainly at this point, seems to be yet another indication of strength. What causes me a little bit of caution as we go to the next chart are the individual stocks, which we won't be able to get to too much today, but if you come back to us on Monday's show, we'll identify some of the individual stocks that are giving us some clear signals. The breadth picture I would describe as mixed. It really depends on what you look at. From a long-term perspective, I would say the large cap breadth and the mid cap breadth relatively strong. If you look at the AD lines overall, very close to all-time highs. It's interesting, as the S&P is making a new closing high or right about it, it's worth noting that none of these AD lines are confirming that. None of the four are also making a new all-time high. Even the large cap advanced decline line, which is here, the second panel of these four bottom ones. A couple of these and three of them are below their 50-day moving average. The NYSE 80 line and the small cap 80 line notably are well below their previous high. So while you have momentum divergence recently, you also have a bit of a breadth divergence where you're seeing the market go higher, but it's not confirmed by these 80 lines. These 80 lines making new highs would be more of a long-term indication of renewed strength. And I think it's still mixed at this point. Yeah, I'm reminded a couple of these charts. I'm reminded of my conversation with Mark Chaikin last week. It was great to have him on the show. And if you missed that interview, go to our StockChartsTV.com, our on-demand platform, and make sure you check that out. It was really interesting to hear his take on breadth indicators. I'm seeing this rotation negative in breadth when we get below 50% of stocks above their 50-day moving average. I think of that as a net negative because for me, I'm thinking of long-term bear cycles when that was the norm, when you have just a lot and very few stocks in uptrends and pretty much everything's going down. That's not a good sign of a healthy market. He was describing more of the opposite. He was saying, look, every time this indicator gets down to 30%, that's been a really buyable dip. So far, he's been proven right. I mean, so far, you've had this nice bounce after these bombed out breadth conditions. Remaining above 50%, I still maintain would be an important indicator that, when that indicator lapses around and gets back below 50%, it just does not give a high confidence of much further upside. You also have to look at the new highs and the new lows, right? There had been a time in November where a lot of stocks were making new highs and an increasing number of stocks making new highs. Here in terms of the S&P 500, same thing, a lot of names making new highs. Toward the end of November, though, you can see very few new highs, a lot more new lows, an increasing number of new lows. What's happened now is while the S&P is sort of working through this equilibrium, working through this range, you also have the new highs, new lows relatively flat. Not a lot of stocks making new 52-week highs yet. Not a lot of stocks making new 52-week lows. You want to see which way that resolves. And a healthy bull market should see an expansion in new highs. You want to see those green bars getting higher and higher going through year end. That's something I'll be looking for in the coming weeks and certainly the coming months. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts, data visualization techniques to better understand investor behavior. A couple quick comments before we get to the mailbag. First off, the questions in the mailbag I'm about to read you all came from you, our viewers, in the last day or two, and I appreciate so much all the questions you guys have sent in since we started doing the mailbag segment on this show. You can get your questions to us at any time via email, thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. We'll hope to answer one of yours live on the air next week on Tuesday's show when we do our next mailbag. Also, go to StockChartsTV.com. That's our on-demand platform. So much fantastic content, great guest appearances. And if you missed some of the ones recently, Tony Dwyer talking about big picture, thinking about the Fed going into next week, some really good conversations that I can't be any more thankful for the richness of some of those discussions. Go to StockChartsTV.com. Also, on your mobile device, just search on any of the app stores for StockCharts TV on demand. Our next segment is the Final Bar mailbag. Let's open it up. These are all questions that have come for you guys. We appreciate it and appreciate them so much. Let's get to question number one. Enjoyed your segment on the Morningstar styles. Can you share the ETF symbols in stock charts which would best correlate to the Morningstar core category for large cap, mid cap, and small cap? Absolutely. So I actually created a chart list, which I called Morningstar style boxes. I'm going to go here to the summary tab, and you can basically see what I did here. So I actually have on one of the papers in my office, I have the Morningstar style boxes kind of sketched out, and I have the tickers in here. I wrote that a couple of years ago, just a way to keep track of all of them, and I refer to it all the time. This is a list, so if you hit pause or if you jot these down very quickly, you'll get them. So basically, you have growth, value, and core for each of the different categories: large cap, mid cap, and small cap. So for large cap, it's these ones that have S&P 500. So you could just use the SPY, of course, but iShares has a core S&P 500 ETF, which is specifically designed to relate to these other style boxes. So you have core, value, and growth. Those are the three tickers there. For mid caps, they're here at the top: IJH, IJJ, IJK. For small caps, you could do two things. So the S&P ones, you use the S&P 600, which have the three, but I've also a lot of times used the Russell 2000. And so you can just use the Russell 2000, then the Russell 2000 value and growth ETF. So those are the 12 that I would use. I would pick whichever we want for small caps, and you can honestly use them, I think, interchangeably. There's some differences at times, but over the long term, you're going to find them fairly similar. I would argue. But that is the answer to your question. The way you find those, by the way, if you ever blank out, is just type up here like mid cap core or something, and it'll identify the indexes that we would have, and also the ETFs that track those indexes as well. Next question: what do the numbers at the beginning of your chart titles mean or refer to? For example, the 100 and 100 SPY market trend, the 210 and 210 SPX greater than 200-day and 50-day, and et cetera, et cetera. So there is a trick to putting your chart lists in a particular order. I learned this first from Arthur Hill and then from Greg Schnell, who are, I would argue, they have an incredible order to their chart lists. Tom Bowley as well. These are guys that have used StockCharts way more than I have for years and years, and showed me the way to organize my login to make sense of the most important things. Grayson Rose and Gaddis Rose also have I would say, a next level thing using different symbols, plus symbols and stars and all these sorts of things. So when you look at your chart list, or you look at the charts within your chart list, it's all about having them order. So it's going to order them by the alphabetical sorting of the names of the charts within the list, or the names of your chart list. You can see on my chart list, I have a couple of these that I want at the top. This one called Random Social Media Charts. I just refer to those just random things I want to post somewhere. I pop them in there. My Mindful Investor Live chart list, I'm often copying things there, so I have them at the top. You can see that the rest of these are in order. So all the broad market chart lists, I put that number at the beginning, because then when I sort them alphabetically, they're toward the top of the list. And the same thing, if I'm going to one of these chart lists in particular, you can see that they are in order of the name of them. And I've just added that number, that numerical code at the beginning. And I usually use 3 digits to do that. You can get really crazy with a lot of different things. And I would encourage you to look at Grayson Rose's show. Tom Bowley, Greg Schnell often refer to their chart lists and show how they have them ordered. By the way, a couple of weeks ago, we did a special chart school series where 5 different people talked particularly about how they manage their chart lists and how they sort them, how they order them. So if you missed that, go to our YouTube channel, go to stockchartstv.com, and you can see those. I would encourage you, though, if you're not familiar with everything I just said, there's so much you can do to customize your login and make it just easier, more actionable for you. The next question, a little wordy, but give me a moment to read it. If the VIX is a measure of volatility, why did it go down when the market was up so big? It skyrocketed in one day after a huge drop. That is the definition of volatility. If it dropped that much, the VIX would be higher, not lower. All these experts keep saying the VIX has nothing to do with up or down, but about how extreme the swings are. It was a huge swing higher in price and the VIX went down. This is why people think the VIX is more about fear than about actual volatility. Can you explain why the VIX moves down on big up days? And in a brief minute or two, I'm going to do my best, and I promise to think about a way to address this maybe in a little more detail when I have an opportunity to dig into it a little further. But so here's the thing: the VIX is often referred to as the fear gauge because there tends to be this inverse relationship. When the market moves lower, the VIX moves higher. When the market moves higher, the VIX tends to move lower. And if you look at the charts, you can see that pretty much plays out. A classic example, obviously, February, March 2020, spike higher in the VIX as stocks are going down. So if the VIX is a measure of volatility, aren't there volatile periods when the market's going higher? So the answer is yes, of course there are. There's a general inverse relationship, and I think it tends to be because of the way that the markets go up and the markets go down. If the markets went up and down the same way, volatility and prices would probably not be as closely inversely correlated. They're inversely correlated because when the market goes down, it tends to be a spike in volatility. If you look at the period, maybe the fourth quarter of 2019, the beginning of 2020, look at how the market goes up the stairs and then how the market goes down the elevator, or as I was told, the market takes the escalator up, the elevator down. Markets tend to go higher over time. It's a little more gentle because people tend to accumulate shares. But when you panic and you feel like you're going to lose everything, you're afraid that you're going to lose your shirt, you don't gently sprinkle in sell orders and gently kind of come off. You panic, and panic, it translates into volatility. So there tends to be more volatile feel to the market when the market's going down because there's a lot of fear driving selling. In slower periods of accumulation, which is what uptrends are tend to be made of, the volatility tends to be relatively lower. However, I would note a couple things. Number one, remember the VIX is not directly measuring volatility on the S&P 500. If you chart the S&P and chart like the average true range would be an indicator that is more of a pure read on volatility. That's showing you the daily price ranges and then averaging those over time. That is literally, it is direction agnostic. And uptrends and downtrends, when the market's more, when the price is more volatile, the ATR goes higher because it's a pure measure of volatility. The VIX is actually looking at volatility in the options market. It's looking at S&P options over a bunch of different strike prices. And if you don't understand what I just said, I would Google the VIX calculation. You can get a lot of detailed white papers that explain the methodology of it, but it's not directly looking at volatility in the S&P. It's looking at volatility in the options market. So the VIX is actually really an implied volatility. It's telling you the volatility in options and using that to sort of determine or make assumptions about the volatility of the S&P 500. It's also a bit of a time frame thing, right? The VIX is measuring volatility in the options market and options with a certain outlook, like a 30-day outlook on average, if I remember right. So there's a bit of a time frame disagreement. So having said that, in general, there is an inverse relationship because of the nature of the way that the markets move higher. And when the market goes down, you have a lot of investors looking to hedge that downside exposure through puts, and that's going to make the VIX spike up very quickly as a result of that. Would be my common guess as to why that happens so consistently. But that is the general answer. There's an inverse relationship because of the way markets trend. It is not one-to-one though. So the VIX can go higher on up days and it can go lower on down days. You'll see that certain days, but on average, that tends to be what happens. We need to wrap the show. We need to finish the mailbag. Thank you guys so much for those questions. Let's wrap this show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. I'm going to start with a sector making new all-time highs today. It is not technology. It's consumer staples. I thought this was fascinating. The market making a big move, closing above 4,700 for just the second or third time. Pretty impressive finish to the day and an impressive finish to the week. Surprising to me that the two sectors making new highs today on a closing basis, consumer staples and technology. We'll get to technology in a bit, but consumer staples, kind of a surprising leadership space right now. And the XLP is making new highs. You're also getting new highs in stocks like Pepsi, Hershey's, Costco, which we've talked about very often, Procter and Gamble, even something like Kroger, while not at a new high, is certainly rotated higher. While consumer staples, I think there are a lot of challenges in that sector overall. Can't help but notice the sector's making new highs. The relative strength has not been super strong yet, but on some of those names, it's actually been a pretty impressive ride. So just because the sector may not be your favorite, and even if you think the market's going higher, that doesn't mean that there couldn't be some opportunities in a relatively defensive sector that are actually showing some strength. Second of the 11 S&P sectors making new all-time closing highs today, technology, which I'm a bit more of a, yep, that makes sense to me. If you look at it within the FanMag stocks, those 6 names, only 2 of them really up big today, over 2%, is Apple and Microsoft, really the 2 tech members of the FanMag stocks. The other 4 were flat to down today. And it's interesting, I was talking with Grayson Rose about this earlier today. Why is I can't believe the long Apple, short Amazon trade is kind of working, but it is recently. I think that has to do with a number of different things, but particularly with Apple, you look at the strength in the stock. It's not a surprise given the strength there. I think a lot of investors could be treating that as sort of their cash position, right? Instead of owning cash, why don't you get defensive and ride a consistent uptrend in the mega cap tech name like Apple or Microsoft? It's a good place as any to park your capital while you wait to see how things play out. Look at the relative strength in technology making a new high today as well. That's probably the most important thing. I'll finish off looking at essentially a pairs trade long forward short Tesla. So far in the last month, not too bad. Today in particular, you have Ford spiking to the upside, up almost 10% today. Now, while that sudden movement can be a surprise, the overall trend in Ford has been fairly strong. The trend in Tesla has been pretty good as well, but you can see that this is more in a descending triangle pattern, lower highs and a pretty consistent support level. Very interesting to see as Ford is resolving this consolidation to the upside. Does Tesla resolve this to the downside, break below 1,000 next week? Folks, that's our show and a wrap for this week on the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.